Recording now. Good evening, everyone, and you're welcome to today's class. It's the session 3 of the series 6 of Money IQ classes. And today, really, it's the continuation of what we started the last time. We started looking at investment vehicles. This is a very important class. I'm hoping more people will look at this or watch it later. It's a very important class. We started talking about the various investment vehicles or tools, if you want to call it that, the last time. We said once you know what your plan is, the question is, how do you get there? You need to have various elements of investment in your portfolio. You need to manage your risk effectively, and that also plays into using various investment vehicles. The last session that we had was on the 2nd of April. I believe that was the date, thereabout, early April. And we had talked about number 1 and 2 and 3, actually, which is individual stocks. We talked about mutual funds. We also talked about index funds. Let me just quickly ask if anyone can give me the difference between a mutual and an index fund. There should be someone in the class that can explain the difference. Now, if not, I'll go over it quickly. What's the difference between a mutual and an index fund?
I mean, from my own little experience, if I
Yes.
still remember, so index fund is more like a fixed income which you can manage yourself, and the interest on it is so small, the amount of percentage you pay on it is so small, whereby mutual fund is more of someone managing it for you, and the amount you pay on it is more higher.
Sorry to say that you're not correct.
That's okay.
But it's okay. You tried and you attempted answering the question, so I appreciate that. So if you remember the last time I explained that a company stock is owning a part of the whole of a company, of one company. That is what a stock is. Really, in fact, I think I have, let me scroll to it. I'm going to scroll. This may look funny, scrolling or, with everybody on the line, but I want to just quickly show you this. A company, let's say Walmart as an example, is broken down into small pieces, and they call the piece of ownership a stock or a share of the company, right? So one share of company, let's say Walmart has 1 million shares in the market that people can buy and sell. It's usually a fixed amount that people buy and sell amongst themselves, right? If I buy one share of Walmart, from that day I became a part owner in just one company, Walmart. So I'm bearing all the risk. If the company fails, that means I might lose my investment in that company. So if you consider a stock like this pie here is a piece of the pie, which is the whole of the company, right? So, but what a fund, on the other hand, is people now say, instead of me just owning one piece of one big company, I can still invest that same amount. Let's say it's $100 I have to invest, but split it over multiple companies. So the companies now started what they call a fund, which is they will now put, like, let's say 20 companies into a fund. So if I invest that same $100 that I could have used to buy one share of Walmart, I might now hold a piece, it may not be up to one anymore, of those 20 companies in the fund. But I have spread my risk across multiple companies. So I'm not completely exposed to the performance of one company to determine my returns in the long run. So that's really what a fund is. You own multiple companies with the same investment. Now, a mutual fund, I was explaining the last time, the key difference between mutual and index fund is that the fund managers, the people that created that pool of companies that you are buying into, they are trying for a mutual fund to achieve good performance, looking at which company should they buy, which should they sell, and as a result, they are always trading, and there's a higher cost, which is along the lines of the cost that you said. There's a higher cost to those that own a fund because it costs you a little bit more to trade and to pay taxes when you continually trade in mutual fund. The index fund, on the other hand, still could have the same 20 company, but it is tied to an index. Let's say like the Standard and Poor 500 is an index, which is a group of 500 companies that have been placed into one bucket or a fund. So if you buy one share of a company's index fund that is tied to the S&P 500, that means they will not need to sell any company, buy a new company, because it's already tied to a fund. I mean, to an index. In this case, let's say the S&P 500. So they don't need to trade it, is the point I'm trying to make. And the cost of not trading is that there's benefit to you. The value rather of not trading is there's benefit to the investor, because you're not paying them to try and buy and sell. You're not paying the associated taxes. So the overall cost of ownership is lower on an index fund. Otherwise, they're very, very similar, because it's simply buying into a pool of companies, either one. However, mutual funds tend to be traded a little bit more, because they're trying to figure out which one will make the most money, which one is should you keep on. And that increases the cost. I was explaining the last time what they call the load or the fees or the commission that you pay to the fund managers. Whereas an index fund, because there is no trading and low taxes or no taxes, the management fees are low. That's the critical difference, or that's the unique difference between the two of them.
So you can also buy mutual fund, but it just
Yes.
have to
Yes.
be managed by somebody.
Yeah, it's still managed by a fund manager, right? But you can buy it just like as you buy an index fund.
Index fund, okay.
Yeah, it's just that the mutual fund, it may not be like the companies in the fund may not reflect like a particular index.
Okay.
Like NASDAQ is an index that reflects companies that are in the NASDAQ, traded in the in that stock exchange, the NASDAQ stock exchange, which are technologically inclined companies. The Microsoft, the Nvidia, they trade on the NASDAQ. So there's a NASDAQ index. So if I buy a fund that is tied to a NASDAQ index, the companies in that fund are already tied to an index. So they don't need to trade it to kind of figure out what to buy, what to sell. You see what I'm trying to say? Yeah. So that's the thing. An index fund is cheaper, and your returns, because of that, cheaper because you don't pay those trading fees and management fees. And as a result, your returns are better. I was sharing this the last time. I shared this screen the last time, that it may look like a small amount. When they say 1% fee, 2% fee, seems like if it's a small amount, but over time it accumulates, because that 1% does not get to compound for you. It's given to the fund managers. You are losing a lot of money in the long run. So in order to avoid that, you get the benefit of a mutual fund, which is you're not tying your returns to one company, but at the same time, you don't lose much, to those fees. So that money compounds for you in an index fund that doesn't get to compound for you in the mutual fund. So I always advise people to use index funds, because you get the benefit of a mutual fund, and then you're not tying your returns to just one company. Does that make sense now?
Yes, sir.
All right. Let's now go through the others that I didn't get to go over the last time. Hedge fund was the one I wanted to talk about, but question and answer did not allow us to get to it. So a hedge fund, again, is anytime you hear the word fund, it means a pool of companies has been created. A pool of companies has been created by the fund manager. 10 companies, 50 companies, 100 companies, 1,000 companies, whatever the number is, right? The key thing with an hedge fund, that word hedge is like a bet. It's like you hear the terms like I'm hedging my bet, right? So it's like a bet. And what hedge fund managers do is, because they want to hedge, they want to create performance that are beating the market. So they are hedging their bet that this company will do better because they've done their analysis, right? They are seeking what they call in the investment cycle, the alpha. Alpha means performance that beats markets. Market performance is referred to as beta, So alpha is performance that beats the market. So a company that is performing below market is performing below beta, but a company or an index that's performing above the market is said to be performing at alpha. So they are seeking alpha. So of course, they're going to take more risk to get higher returns. So they generally won't invest in traditional stocks alone. It doesn't mean they won't have stocks in their portfolio, but that will not be their major strategy. They will be much more aggressive. They will use things like what they call derivatives, you know, they might use more borrowing, you know, be more levered or leveraged in order to get better returns overall for their investment. So it's usually a little bit more aggressive in that sense. So for you to participate, because to protect general investors, those that are not as educated, the Security and Exchange Commission limits those that can participate in a hedge fund. You can't just go out, as in the case of a mutual fund or an index fund, to buy a hedge fund. You are invited, or you are qualified, if you can say that, as what they call an accredited investor. And what does it mean, or what does it take to be an accredited investor? You need to have a net worth of $1 million at least in the United States. And that does not include your house. That is, your net worth, other than, not in your primary house, not included, must be at least $1 million. Or that you have an annual income of at least $200,000 over the last 2 years, if you're a single person, and over $300,000 if you are married. Okay, so if that's over the last 2 years as well. If you meet those criteria, either of those two criteria, you can invest in a hedge fund. But you can't just simply go and look for them. There are hedge funds. You have to identify them, or they might contact you based on your investment or the understanding of your finance and ask you to come into the fund. Okay, so generally that is a hedge fund. The other thing I want to talk about today really is, this one is really important. I hope that you're all participating in company-sponsored retirement plans. If you're not, someone said once that he cannot afford. He was asking me if he should participate. He said he can't afford to. I said you can't afford not to, because it's almost like free money. That if you don't participate, you simply lose. And there are different ones for different sectors. The private sectors is called 401k. The public sector is 403b, and then like government type organizations like schools. Actually, schools are 403bs, but like local governments are like 457. But really, in principle, they are pretty much the same to a large extent. And it allows you essentially to contribute pre-tax, a portion of your income pre-tax, because you know that the government wants you to pay your tax, right? So generally speaking, you invest after tax income. You're allowed to invest whatever you want. But here they allow you to take, let's say you make $5,000 and you decide to put 5% out of that into this kind of retirement plan. 5% of 5,000 is that 250 something?
250.
Yeah, 250. What that does is that it reduces your tax from being based on 5,000 to being based on 5,000 minus 250. So your tax is now based on 4,750. So you pay lower tax, and that money can then compound for you pre-tax. I'm going to show you an interesting evaluation. Someone has asked, okay, why don't I pay my tax now so that I don't owe tax on the money in the future? And I say it depends on what you're doing. So I will show you something that will help you to think through that in a minute, But the key point is you can put that money in these investment vehicles pre-tax, and it grows essentially tax deferred. So you pay your taxes whenever you take it in the future. That is the benefit of it. One key point is you're not allowed to withdraw before you are age 59 and a half. You can, but if it's a real withdrawal, then you're going to owe tax. On top of that tax, you also pay a penalty of 10% on top of that tax that you owe. So it's advisable. You could borrow against it, but you don't want to withdraw it, as it were. Okay. This slide shows us the limit. I won't spend too much time on it, but it shows the limit. Actually, I have 1 or 2 slides on limits for these different things. You can contribute up to 23,500 if you're below 50 years of age. If you're above 50, you can add another $7,500 as part of your home contribution. And then between the age of 60 and 63, kind of because those people are getting close, to help them put some more money in retirement if they can afford to, instead of 7,500, they can add an additional 11,250. So that means potentially up to 34,750 in that age bracket. And then this is the one that's pretty interesting that most people don't kind of tend to take advantage of, is the individual retirement account. This is not company sponsored. This is individual funded or sponsored. It's tax, it's tax deferred as well, tax free for a long term. So tax deferred, I should say, for a long term. So there are 3 general types I want to kind of talk about. The traditional IRA is very similar to what a 401k does. Very similar. You put pre-tax money into it, and you can open this in any of the financial institutions. You can open them in banks. You can open them in investment brokerage firms and stuff like that. So you put pre-tax money into it. Now, generally, if you're not someone that has your own business, your tax is taken, they call it pay as you earn, right? So you don't get to do that. But when you file your taxes, you can deduct what money you put into it. So it ends up being the same as a pre-tax investment. If you're someone that works for someone and then you own a traditional IRA. And because it's pre-tax investment, when you withdraw it in the future, then you have to pay the tax. So the tax is essentially postponed, as I wrote there in parentheses. The Roth IRA, on the other hand, you can only put post-tax money into it. I talked a little bit about this the last time because there was a question that came up. You put post-tax money into it, and whatever returns you get, whatever growth you earn from that investment, you don't owe tax on it in the future, as long as you keep it there for at least 5 years. You don't owe tax in the future. For me, I tell everyone you need to participate in a Roth because from a strategic point of view, you want to minimize your taxes. Taxes is one of the things that really eat into potential returns in the future. And then there is the rollover IRA. Money that you contributed into the company-sponsored 401k, 403b retirement plans and all of that. If you live in a company, I always advise people to roll it over into a rollover IRA. You roll it over, and then it's called, a rollover IRA because it is rolled over, as it were. Those are the 3 basic types of IRA. Please feel free to slow me down or ask me questions. Now, because there are benefits of not... Okay, Sister Disola, go ahead. You raised your hand. Sorry, Dr. Samuel, go ahead.
Okay, sir. For the IRA, the Roth one, is it the manager of the fund that they're going to be kind of trading with it, or or one has the prerogative, or let me say the opportunity to be the one trading or wherever?
Yeah. So anytime you see the word I, which is individual, it is in your hands to manage the fund in that. So any of these individual retirement accounts, you need to put them into an index fund, okay, of one type or the other, which is some of what we're talking about today and we talked about last week. So you can open it, put 10,000 in it. If you don't invest it, it stays as cash. The brokerage does not invest it for you. You manage the IRA, and it's not difficult at all. once you understand the things that I've been talking about, you just decide on the index fund, what class of index fund. I'm going to say some things this afternoon or this evening in this respect, along the lines of asset allocation. Once you know what you're doing, it's not difficult. You just put it into the index fund that allows you to achieve your goals. Does that make sense? Does that answer your question?
Yes, a lot of things, sir. Yeah, this is a very good one.
All right. All right. So because usually this money is pre-tax and the government they want you to pay your tax so that everybody don't put money and there's no tax to the government. There are limits to it, right? So the standard contribution to a Roth IRA is $7,000. If you're above age 50, you can make it 8,000. That is an extra 1,000. But also, if your income is over 150,000 or 236,000 for a couple, then you are not allowed to just participate in a IRA. There was a question last week from one of the participants about what they call backdoor IRA, and I discussed it at that session. But since we're talking about income limits, what provision has been made, however, is that even though there is a limit of 150 for single and 236 for a couple filing jointly, so if your income is above this, what they call your modified accrued gross income in your taxes, once it's above that range, you're not able to directly contribute into a Roth IRA. However, you can contribute that money into a traditional IRA, and then and make it an after-tax contribution into your traditional IRA. I hope I actually talked about that correctly the last time. So anyway, when you contribute into that IRA, what that happens is when you now file your tax, there's a form you can file, which allows you to move, because it's post-tax contribution that you made into that IRA. They move a portion of it subject to the limits, right? The same limit of 7,000 or 8,000 if you are 50 years old or older. Subject to that limit, let's say you put 10,000, you can only take like 7,000 if you're less than 50 and 8,000 out of it and convert it into a Roth, essentially. So you roll it over essentially into a Roth IRA. It's called a Roth conversion. Okay, so it's still possible to have a Roth performance even though your income is above that limit, but you have to go through this process of filing. The biggest thing is this step number 2 is that you file as part of that tax annual taxes, the Form 8606, which allows you to convert some of your money in a traditional IRA into a Roth. And it's called a Roth conversion. So because some people say you can't because of your income, that's true. Generally, it's true, but there's a backdoor that has been created, and that's another way to access it. And these are the limits. I won't spend time on it. These are the limits based on your income. You might hit that limit. You may not hit the limit, but generally speaking, these are the limits. This was as far as of last year. It might have changed in this tax year that we're in 2026. So if you're under 50, you can contribute about 30,523 plus 7 to your IRA. If you're over 50, it actually adds another 7,500 to that base, another 1,000 to your IRA, bringing it to a total of 39,000 if you have above 50. So your limit is higher, as it were. So, but however, total, there's a limit of between what you contribute and what your employer contribute. This is 72,000, obviously, so these are the numbers. For one thing you'll notice is that the numbers changes every year. So it's been increasing. IRS has been increasing the limits. So right now it's 72,000 is what that limit is. Let me correct that number. It's not 72,000, 72,000. So at the end of the day, all of it, Roth plus plus regular, cannot be more than 72,000 that you contribute, as it were, regardless of your age. between the individual and the employer, as it were, at least in this year's tax season. One thing is also what they call the Roth 401k. That's another good opportunity that is there for those that hit the limits very, very quickly based on income. It allows you to invest, money that you've already, paid taxes on for your retirement. That is like the Roth performance or the Roth provision, investing post-tax return income so that you don't pay tax in the future. So you can contribute to a Roth 401k, and the good thing about it is that it can grow tax-free, because it's post-tax investment, as it were. Also, it grows, and you can withdraw your contribution plus the growth tax-free in the future in a 401k if it's in a Roth 401k account. And then it also does not have the income limits of like your regular 401k, because not the 401k, the Roth IRA. The Roth 401k does not have the income limit of the 150,000 or the 236,000 I mentioned earlier. Whatever income you make, you can put money into a Roth 401k. However, at the end of the day, everything is still subjected to this cap of 72,000 a year for 2026. Between your 401k and your Roths, you're subjected to a total of 72k between you and the employer. These are important things to know or to note, because the more you can put into a Roth type investment, the better. It's just that you need to pay tax on it today, right? But the more you can put into it, the better. However, I always try to explain. Someone said, okay, so what's the difference? Should I pay tax today so that I don't have to pay tax tomorrow? Or should I pay tax tomorrow? I say, it depends. You need to know what you're doing. So I put this together to help people to understand this principle. So I have these two individuals. Please listen to this. It's very, very important to help us think through this logically. So I have Mr. A and Mr. B. Mr. A chooses to pay his tax today. Mr. B chooses to pay his tax 35 years from today. So they both earn $5,000 as income. Mr. A, because he's paying tax today, all his income is taxed. So he's taxed based on 5,000. Mr. B, on the other hand, chooses to invest pre-tax. Let's say he invests 6%, which is $300 pre-tax, right? In a 401k, as an example. Then that means his taxable income has reduced from 5,000 by 300 to 4,700. So if they are both taxed at 20%, Mr. A will pay 1,000, Mr. B will pay 940. So Mr. B has an extra 60k that he can put into investment for the long term, right? I now put at the top right here, what is the value, using the same sheet which I have shared, the future value analysis sheet, the value of $60 invested monthly over 35 years at 10% annual return is $195,000 over that period. Now, he's going to hold tax in the future because he didn't pay tax today, right? Remember the principle, if you either pay it today, you pay it tomorrow. So is on this 195, assuming he now takes it off, he has to pay based on capital gains tax and his income bracket. I have a table that I can show you. Let's assume he pays the high, which is 20% of capital gains tax. He owes 39,000 when he withdraws it in future. So he's paying 13,000 more than this other individual. The cumulative tax that this guy pays over 35 years is that extra $60 that he's paying a month times 12 months times 35, which is 25,200, right? That is Mr. A. Mr. B, on the other hand, pays $39,000 over when he withdraws in future. So he pays $13,000 more. And that's what people are usually thinking about. He's paying more taxes. But look at the fact that 195 minus his tax is still 156, which Mr. A doesn't get to have because he didn't invest the $60. So yes, we pay higher tax in the future, but that is money that, you wouldn't have had anyway because you didn't have it to invest. However, you have money left over of another 156. Now, this is very, very simplistic. I like to explain, because it depends on your withdrawal pattern, your strategy at that point, on how you take your money out in the later. It might put you in one bracket or the other, but it illustrates very, very well the value of pre-tax investment. So I hope you understand that. That's a very important distinction. I tell people I would rather invest, especially if you can invest that money wisely. If you don't invest the money wisely and you just keep it as cash, then you don't really benefit, right? But as long as you invest it and you take the return which the market can give you, it's about 10%, you will get, you gain more, you pay the taxes in the future, but the value is there to be had in the future. So that's my explanation. If there's any question on that, please feel free to just raise up your hand and ask it. That's a very, very critical distinction I want people to understand. Okay. I always tell people that at the end of the day, the critical thing is managing your assets very, very well. You need to allocate your the money that you have saved. That is your asset. You need to allocate it properly. Don't put all your eggs in one basket. Warren Buffett says, never test the depth of the river with both feet. Don't put, you're not sure how deep this water is. Don't put your 2 feet into it to find out. You use one, at least protect the other, so that if something wrong, you can take your leg out, And that talks about portfolio management, really. You're trying to not, it's similar to what you're doing with investing in funds rather than in a single company. You're trying to spread your risk across multiple asset classes. And then you're also diversifying within an asset class. Let me try and explain those two terminologies quickly. And I always tell people that asset allocation is more important than diversification when it comes to risk management. What is asset allocation? It's really determining, I've talked to us about stocks and bonds mostly today. And the last class, I will go through a couple of all the others today. But making sure that your investment is in the various asset classes is important. So, for example, let's say you have 30% in stocks, 30% in bonds, 20% in real estate, 10% in annuity. That is allocating your fund. You're putting your fund in different buckets. That's why it's called asset allocation. But even in one asset class, let's say stocks is an asset class. You don't just invest it in one company. That is where diversification comes in. So you are moving it into multiple companies, low cap, mid cap, high cap. Cap or capitalization is the value of the company in the market, which is the number of stocks in the market the company has times the cost of each or the price of each stock. That is the market capitalization. A company that has a market capitalization of less than 300 million is called a micro capitalized company or micro capital company. A small cap is between 300 and 2 billion. Mid cap is between 2 and 10. And then large cap is over 10 billion. Large cap, mega cap, over 10 billion. I think they even created another class. I think it's beyond large cap. They created one, they call it now, because there are some really, really big companies today, and they call them mega cap. I'm not sure what the limit is on that. But my point is, you put your investment into these different categories. Again, that's part of your asset allocation diversification strategy. You don't put it in one class, as it were. Someone has the question in one of the classes in the past, that, okay, so how do I construct that bucket? How much should I put in which bucket? And I tell people, it depends on a number of things. One is the stage in life you are. As you get closer to the age when you need the money, you don't want to put your money in things that are deemed higher risk, unless you are more risk tolerant, which at that point you're really trying to gamble, if you want to say it that way. You don't need to. That means at that point you're putting more into cash, so that the one that needs to stay for long time in the market, you're not dipping into it before you ought to. So the stage you have means you need to change how much you have in cash and cash equivalent versus what you have in stocks and funds and stuff like that. That is one point to make. And of course, your risk tolerance. You know, some people are so afraid of losing that they just can't win in this in the market. So your risk tolerance is another thing. And then of course, how much money do you have? You know, if you have more money, you can afford to be a little bit more aggressive in these things. Now there is a portfolio I generally recommend for people, but people should feel free to do what makes sense to them. But you know, the key point here is that you need to be across different asset classes, and even within an asset class, it should be properly diversified. And then you need to review your portfolio. I tell people, some people don't even look at their own 401k account. They just leave it there. They don't know what is invested in. They don't know if the company they invested in is doing well. They don't know. And in fact, some people even leave it in their company stocks. And I tell people that is not a good thing. You don't leave your money in a company stock, in the company that you are working. Put some of it into it if it's a good company. That's a great strategy, but not all of it, even if the company is doing great. And I think I've used maybe not in this class, in one of my previous classes, the illustration of a company in Houston here called Enron. Enron went bankrupt, and all the people that were, that worked for the company and left their 401k in the company stock, they lost their retirement, So you don't want that to happen to you. You need to make sure that not more, and I always tell people not more than 30% should be left in your company stock. You can do, up to 30%. Put the remaining in index funds that matches your portfolio allocation strategy. So what is my recommended allocation strategy then? What I always tell people, not always, but this is the strategy we use. And I learned this from Ray Dalio. Ray Dalio is the founder of Bridgewater. I think I've asked us to read one of his books on the platform in the past. A very, very successful asset manager. Yes, this is not exactly the way it's constructed, but it's not too far from this. This is the one I use, and I tend to recommend something close to this is what we do. 30 to 40% in U.S. stocks, about 30% in U.S. stocks and 10% in international stock. Again, I use index funds mostly. So when I say stocks, I'm talking about stock index funds, So if you do 30%, remember that stocks are generally about twice as volatile, essentially as risky as bonds. So if you do 30%, that means you're exposed to about 60% of your risk. Your overall risk is already from that. If you do 40%, then 80% of your risk is already carried. You're carrying 80% of your potential portfolio risk. So I tell people don't put more than that, because you are exposing yourself to a higher risk profile if you do that, So if you do something like, let's say 40% in US stock, US, because look, whether we like it or not, US is a very stable economy. It's one of the most powerful in the world. Some of the biggest companies in the world is in the US. So you should participate in the US fund. International funds opens you up to opportunities outside of the US, but they are not as good as the US. They are not as stable. They are not as solid as the US. So I won't split 2020. I will do 30 in the US and 10% international. That is overall stocks and stock index, 75% of it in the US, the next 25% in international index funds, stock index fund. Then I'll recommend like 30% into bonds. And then we're going to talk about all of this in a little bit. 30% into long and intermediate term treasury bonds. And what are those things? I'll talk through it in a minute. And then 20% in real estate or real estate index funds. And then 10%, this is now where your cash is, the CDs or CD type investment, money market, and things like that. I had shared this video some time ago. I could share it again after today's session that tells us about how the economic engine works. I'll share it again. Please listen to it. When you understand that, it will help you to appreciate why I ask people to not just use stocks. Go across stocks, bonds, real estate, and CDs. That way you are across the different asset class in terms of allocation. And then even within each of the class, you properly diversify, as I explained earlier. Please feel free to slow me down. Normally, I will have, if we finished last week's class, I will have asked us to go through this assignment, but we'll skip it today just to help us to think through what's it called, an index fund, the different things that I've taught in the last two classes on an index fund, but I will skip it today. Another important investment vehicle that I want to speak about today is your college savings. For those of us that have children, the earlier you start this, the better. I always tell people there are two types of college savings fund. One is called the 529 plan, and then the other one is called a Coverdell. They are similar in principle, but have some differences. Let me start with that 529. 529 can cover education expenses, both in the elementary type, middle school, up to college education course, even apprenticeship program. And when you put money into those plans, it functions almost like an IRA or a retirement account, because you can then put it into an index, and then as it grows, you can withdraw the money in the future as long as you use it for educational expenses without tax. It's tax-free. It's not tax deferred. It's completely tax-free. It's almost like an Roth, and then you can also, there are two types of it. The savings plan, which is like that, or one where you do a prepaid, tuition. With that one, you simply pay your college today with that fund. As a result, you don't pay higher cost tomorrow when things are more expensive. The difference essentially between a Coverdell and a 529, which I just described, is that Coverdell is, has a limit. Okay. The cutoff amount for a Coverdell is $2,000 a year, whereas a 529 plan, there's no limit to how much you can contribute into it. Coverdell funds must be used by the time the child they are investing it for turns 30, or by the age of 30. If not, there are penalties that will kind of kick in. Whereas with the 529, there's no maximum age limit. It can be used for, anything beyond that age, even going to taking kind of correspondence things and stuff, as long as it's education. And then parents and grandparents can contribute to, this kind of plans, for others. This table I have it that talks about the same differences, the age restriction, and all of that that I just mentioned. So I won't dwell on it. Okay, another investment vehicle is annuities. Annuities essentially are insurance. That's all it is. It's an insurance contract that you buy, and then you pay into it, and then it promises you a guaranteed, payment back in the future. You can either do it as a lump sum or in a series, and you will receive. It's actually the returns that you receive that they call the annuity, and it's taxed obviously as a regular income tax, not as capital gain. And the table at the bottom shows, I was kind of speaking about this earlier on, your tax bracket for capital gains, income from capital gain is tied to your income, your adjusted gross income. So let's just look at some of the numbers. If you're married and filing jointly, up to $98,000. If your income is up to $98,900, you don't hope, and then the money you make from investing in the markets, you don't hold taxes on it. As long, by the time they put it all together, it's less than 98,000. You pay no tax on your capital gains, which is good. Between 98,901 and 613,700, you pay 15%. This is, for this year's tax bracket. It changes slightly every year. Again, I'm looking at the married filing jointly. And then if it is above 613%, you pay 20%. Okay, so once you file your taxes, depending on the bracket you fall into, it will determine how much you are charged as taxes on capital gain in the future. Which is why I use 20% on that example of someone that deferred taxes for 35 years earlier on. Okay. Real estate investment trust is another important one. It's a company that essentially invests only in real estate. They call them trust. They invest primarily in real estate type properties, malls. These are the people that invest and build big malls, or in companies that build malls and things like big, central downtown type high-rise building and things like that. So it's called real estate investment trust, or a fund that invests in REITs, in real estate investment trust. That's a way to invest in real estate without you essentially buying real estate. It's one of the ways to invest in real estate. So that's another way to, diversify your investment. I talked about derivatives earlier on, very, very briefly. Again, individually, you can actually invest in derivatives through your stockbroker. You can invest in what they call options. A option is I would like to say the right to buy or to sell. It's called an option. A call option is the option or the right to buy a stock at a future date at a particular price. For example, let's say a company stock is selling today for $20, and you think that in the future, that company stock might actually be higher than this. But if you buy a call option, you pay some kind of premium, and in the future, let's say they are now selling it for $30. You can buy it at that option price of $20 that you have paid for, even though it's now selling for $30. So you can buy it for $20, even though the market is 30, and then you just turn around and sell it the next minute at the current market price of $30. So you make $10 for every share if you buy a call option. So that is what it is. But similarly, you might think, and they usually have like an expiry date. If you think it's going to go up and it goes down, then, let's say you're holding a call option of $20 and the stock went down to $10. Are you going to exercise that option? Obviously not, because it's out of the money. You can't buy something that is currently sold at $10. You can't go and buy it at $20. So you lose that, option that you bought. The put option is essentially the opposite of that. It's the right to sell. That's why it's called a put, to release. The right to sell at a particular price, regardless of what the current price is of that stock. So those are the call and the put options. I explained that hedge fund managers do this a lot. Again, remember they are trying to hedge their bet. They are thinking, and they do this with a lot of calculation into it, a lot of statistical modeling to try and figure out the direction that the company's stock will perform over time, as it were. So those are options. I'll skip that. I think that's enough to explain on that. If anyone has a question, you can ask me. Bonds, essentially, when you buy a bond, you are buying a unit of a debt, either of a government debt or a private company debt. Government debt is sometimes called a treasury bill, okay, generally called a bill for the federal government. A city's bond is called a municipal bond. Companies will be called a corporate bond. And then there are, this is a junk bond, could fall into any of this category. A junk bond is a non-dependable bond, a bond that you may not make money on in the future. And there are companies that rank them. The one on the right shows Moody, S&P, and Fitch. And anything below the red line that I have on that screen there, let me put my pointer on so you can see my pointer. Anything below this red line is referred to as a junk bond, based on the rating of these agencies. Above that, those are companies that, or the government organization that these agencies think they will do well. You can't lose your money investing in them. I generally won't buy bonds directly. I will buy in bond fund, because that kind of spreads your risk across multiple companies, and also you're looking for those that are well rated, as it were, within those bond fund. Okay. All right. You can also buy precious metals as a way to diversify, not properly asset allocate. But the truth is, in today's world, you're not going to go and buy a billet of gold. You use a fund that invests in those kind of assets, precious metals. So you don't need to buy gold, but that's another way to diversify. Okay, one key thing I want to leave with us on this particular focus for today is that the goal is to start by building your financial cushion. And I've talked about this almost till I'm blue in the face now. You need to build your cushion so that you can, as your investment is growing, you're not tempted to go sell it when the market is going down, because you need cash. So once you have that cushion, it doesn't matter what the market is doing in the short run or the long run, you focus on the long run, so you don't allow yourself to be fidgety when the market is down, because you have cash to take care of your needs. Remember, as I've explained at the last class, your goal is to turn assets into income. To do that, you need to learn to lower your expenses, grow your income, limit your liabilities, so that you are growing your asset column in stocks, bonds, and all of these things. And those now become sources of income. The income is the goal of investing at the end of the day. Income is the goal. So that ability to make money, whether you are sleeping or awake, is where you want to work towards. We need to focus on long term. And I've talked about this before, that I want us in this class to be investors, not traders. Okay, I said this just a few minutes ago. Asset allocation and diversification are really critical. I want us to learn to rebalance your portfolio every year. Maybe things changes over time, but look at it and try and put it back in that same bucket that I explained to you, that 30% in stocks, or 30 to 40% in stocks, 30% or so in bonds, 20% in real estate, and 10% in cash or cash equivalents. Okay, so that you don't sell out in bad times. I hope everyone on the line now has an investment account, and everybody in these classes that have been following me has an investment account. I can't say this enough. We all need to open an investment account. Is this really about where we will be ending for tonight? And my request as an assignment is, if you don't have an investment account yet, please open one. Please open one. If you participate in a company's retirement plan, one or the other of the ones we've talked about, keep your portfolio reviewed at least once a year and keep it balanced. Don't leave 100% of your company's, of your 401k in your company's stocks. Or the organization may not be a company, it can be a government organization, stocks. My recommendation is 30% or less of your portfolio, your 401k or so portfolio should be in the company stock, not more than that, so that you're not overly exposed. And then, generally speaking, you use index funds, not mutual funds. I've explained that again at the beginning of today's class. Use index funds, not mutual fund. I think I'll end there tonight, and we'll continue in class 4 with kind of a Q&A of all of these things that we've talked about. And then we'll focus more in that class on real estate investment, and then wrap up the sessions. So I'll open it up to see if anyone has any question. That's really where I will end the class tonight. If anyone has any question, please feel free to ask. If not, we'll stop it there for today. And
I have a question.
yes, ma'am. Go ahead.
How do you know which bond to buy? I look at just Schwab's and the bonds, and like you said, there is the treasury one, there's like corporate, municipal, and the rating like they have 3 A's or 2 A's.
Mhm, mhm.
So it's kind of confusing to me.
Okay, don't worry. I can sit with you, and
Okay,
take you through it a little bit more. Let's find time
okay,
to kind of help you think through the different in brokerage firm. Their site might be slightly different here and there, but the principle is the same. So I'll sit with you and we'll walk through it.
okay.
Okay. All right.
Sounds good. Okay.
I do have a question, sir.
Yeah.
Thanks for the teaching. God bless you. My question is on annuity. The annuity, is it at the point when one wants to withdraw that the fund is being subjected to tax?
Yes.
Okay.
Yes. It's at the point of withdrawal. Any of these things that we talked about today, when you are subjected to tax, is always at the point of withdrawal. All of them. So because what the government is looking at, and it may not be like immediately, but by the time you file your taxes for that year, it's going to reflect that you have collected some annuities, right? So whatever tax is due will show up based on your income and all of that. Now it's taxed at your as ordinary income rate, not as a capital gain, but you pay it as part of the taxes for the year. You see what I'm trying to say?
Yes, sir. Thanks for the clarification.
Yeah. Good. No, good participation. I appreciate the inputs. I'll go ahead and stop the recording, and we'll continue from there the next time. I appreciate everyone's participation tonight. It's been encouraging for those that were able to make it. For those that are not able to, that's okay as well.